Today, we are starting with my very special guest and very good friend, Scott, over at the most incredible VC advisory, investment banking, and investment firm in the world, which is the great, the one, the only Black Dog Venture. Scott, welcome to the show, my friend.
Thanks, Brian. Glad to be on.
And I normally spend the first 5 minutes or so just waxing lyrically about a bunch of crap that nobody wants to hear about just because I feel I should do that. But actually, because you're here, I feel we can both do that really
Oh,
well
I got
together.
I got lots of crap to put wax on. So
So today we're going to talk about investment. Scott is the master of the industry. I'll let him introduce himself in a second, but based over in Florida these days, used to be based over in LA. He and I have done so much around investment together. I would say between us, hundreds and hundreds and hundreds of millions of dollars have been raised, either for my portfolio companies, his portfolio companies, people who are his friends, and other people who are out there. There is no question there are maybe a handful of people on the planet who have seen more deals than Scott. So when it comes to what should a pitch deck look like, how do you pitch? How do you make people want to invest in you? How do you make sure that you return money to investors? Like all the stuff that is around money, there is no better man than Scott. So I want to see the chat like really active. Any of you that are looking to raise, any of you that have questions, put your stuff in the chat. Now I know that takes a couple of minutes to get started normally, so we're just going to kick off with some of the fundamentals. Early stage, venture backable company, pre-seed, seed, looking to break through in a market like this. Scott, after you like tell a little bit about yourself and about like, I mean, there's so much to tell. Honestly, I don't even know how you condense it. But let's kick straight into this market that
sure.
we're in and like how should startups be approaching it?
Well, a little background on me for everybody listening in. Thanks again, Brian. I've been on both sides of the coin. I started out as a deal guy. I started out on the floor of the New York Stock Exchange in the 80s, worked as an investment in San Francisco, 86 to 93. 93 in the midst of the dot-com boom. I was a founder, had my first internet company, was fortunate to have three exits between 93 and 2000. Retired briefly, started another business in entertainment, sold that in 2006. And then I really launched Black Dog Venture Partners as really as an accelerator to help these early stage companies get ready for investors, find investors, build and grow their business, and then have them have an exit down the line. So I've been on both sides of it, and it's a fascinating time we're in right now, and I'm sure we're going to jump into that.
Yeah. And it's also, you've also gone the full spectrum. Like a lot of people in venture, like I specialize in the very early stage space. So I live there. But ask me about Series B or Series C. I'm like, I'm not sure I know so much. But like early, I know an awful lot. The really nice thing about you is you've taken them all the way, both your own companies and other companies. You
Yeah.
spend as much time around exits and public market space as you do within the early stage space. So we're going to touch on all of that. But first of all, we're in a really weird environment right now with investors. I actually sat with a good friend of mine and yours on Friday night having a beer. And this is a guy with a legitimate top great fund. I mean, I maybe one of my top respected VCs in LA. And he's like, Brian, there is no liquidity in limited partners. The liquidity has been sucked out of the market. What the hell do we do? I haven't had a conversation like forget 2006, 2007. I didn't really have that conversation in 2006, 2007 because it was real estate that was hit, but other markets were kind of sort of okay. And it was only a year or two. But I'm having it all the time right now.
Right.
What's happening in the venture space? What's happening with limited partners who are the people who fund the general partners, which really is the entire lifeblood of
Right.
all venture. Once that artery stops, you're done for. The whole market's done for.
Yeah, absolutely. You and I both know over the last few years, the public markets have not provided liquidity, and there's only limited opportunities. Sure, there's opportunities to have an acquisition, have a buyout, and possibly use the secondary market to some extent, but they're really dry. And these limited partners have been in these deals for years now, and folks like you and me don't get our return and don't necessarily get paid until there's an exit. So it's been a really rough few years. And honestly, the whole nature of venture capital investing is changing now. Gone are the days where an entrepreneur can say, look, give me $5 million as a brand new entrepreneur, and in 18 months, I'll have an MVP. People are just laughing at that now because with AI and what we can do on the no code side and what resources we have, that model is changing. And I think it's gonna lead to much better companies down the line, in my opinion.
Yeah, I actually heard I'm not a big listener to Jay Cal and his All In podcast, but I heard him on. He was on with a bunch of folks, Dave McClure, X500 Startups, and a bunch of other people as well. And they started talking about these new funds, which are 10 to 15-year funds. And it
Yeah.
used to be, it was this whole conversation around where Dave McClure was saying, yeah, but I don't get it. Like, you can't just say we changed the fund from like 8 to 12 to 10 to 15. And it's because the market cycle has become so much longer. And in some ways, a lot of these private companies are not looking to come public. But what this all means for the early stage space is that you don't have tons and tons and tons of angels who may have been in real estate before, which is blocked with the interest rates, or who may have been getting money from like their public stocks, which has been blocked by companies going successful IPOs, or maybe they would have got their money from acquisitions, but the acquisition market has been really hard right now, that the market is stuck. So in that environment, which we expect to last at least another year, right?
Mm-hmm. I would think so. Yeah, I
Yeah.
think obviously we have, we were really, given really low interest rates for a period of time, and we don't really have those low interest rates anymore. And that's obviously creating some challenges and some opportunities to get better returns, get alpha for these venture funds, and in comparison to what's happening in the marketplace. But it is going to take a while. We've had a handful of successful IPOs now. It's starting to open up, but we don't have the frenzy, that we had in the 1990s or even parts of the 2000s. We just don't have that frenzy. And the amount of public companies in the marketplace are down by 50 some odd percent. So there's just not a lot of public equity out there. It's starting to come around. But yeah, we are, outside of the big name brands, in AI with the large investment banks, liquidity is really challenging. And you're right. It's going to be a little while before that opens up.
And we're going to talk in a moment just about tips and tricks, but I want to put one point in here just beforehand, get your thoughts on it. And we always hear this stuff like, this is the best time to actually start a company. But I really think actually this 12-month period, a lot of people think like those heady days of the early 90s or very early 2000s before it all crashed, or even maybe 2019, 2020, 2021 are the best times to start a business. They're actually not. It's not that like when these really great times when the markets are going crazy, it's not a great time for like pre-seed. It's a great time for seeds to Series B. Like that's
Right.
when it's an exceptional time for, right? So you want to be able to make sure you build it up, because rather than getting 5 million for a Series A, you're going to get 15. And rather than getting like a valuation of 50 million for an A, you're going to get a valuation of like 150 million. Like that's when things go nuts there. So the
Right.
reason why this 12 months, if you're thinking of building, starting, going hard or going home, you have to go hard, because this 12 month is going to wrap us up to a period of just extraordinary gains. But you got to be a winner. You got to
Right.
be a winner. If you're not a clear winner during this period of time, then you might as well go home. But if you are a clear winner, if you're in that first group that are breaking away from the pack, you are going to be in a position when we hit 2026, mid 2026, 2027, there's going to be fireworks in the sky.
Right. Agreed. I think the reality is, I'm telling the entrepreneurs we work with, you've got to paint the race car while you're driving it. You've got to be constantly, you're a growth hacker. You've got to constantly be building. And there's no excuse not to constantly be building. Like I mentioned before, with AI and no code and these opportunities, waiting is going to be your detriment. Waiting for the money is not going to make the money appear. Earning the money is going to make the money appear.
Yeah. And so what you're saying is like best investor is your first customer, right? And the more you show your first customer, and then it's about dropping that information. So I'll throw two or three things in, and then I'd love to layer on, add other things as well, because I know this is what you say anyway. Number one, it's a numbers game. It's not a silly numbers game. It's a smart numbers game, right? So you got to take as many of the most likely people as you possibly can, and you got to put it there. And then number two, you got to make sure that your customer, you're driving that growth with the customer, because you can't sell empty air right now. Nobody's buying it. But then if you have that, you have to be really smart and then drop all of the successes you're having to all of the investors on a basis like that's how you win, right? Is it any more complicated than that?
No, not at all. I tell everybody this is a three-legged stool. And what I mean by that, that first leg is building relationships with investors. And let me define what that is. That's not waiting till you need the money and then slamming your pitch deck into every LinkedIn profile you can get your hands on. That is not building relationships. I tell entrepreneurs, if you want to raise money, start 6 months ago and build those relationships. So you need that funnel. It is a numbers game. You have to have 100, 200, 300 people that you've established relationships on the investor side before you go out there and market. That's the first leg. Second leg, I tell everybody in real estate, they call it, the phrase is location, location, location. In startups, it's traction, traction, traction. Continue to update your investors on what's going on. And then the third leg is really some third-party endorsement. Get on podcasts like this. Become an expert in your space. Get that third-party endorsement, because all of those things lead to a successful transaction. Because the reality is, investors like you and like I see hundreds of pitch decks a month, hundreds. And the reality is, you have to make sure they see what you're doing and see that you're growing. I did an event years ago. We had a really renowned investor on the panel. And one of the entrepreneurs asked, hey, how do I get in contact with you? And he said, do something interesting. I'll find out about it and contact you. So it really is that three-legged stool.
Yeah, incredible. And when you and so the other day, I did something very unique with you, right? Only time I've ever done it before, which all the time previously, I've been an investor, come in, and while you're bringing your startups in and you have all of the investors who come in from the outside to invest on top of what you're doing, I'm normally a very, very proud and happy part of that. But this was the first time that I came in as a founder. Now, I came in as a founder because we at Expert Dojo have realized the same thing that Scott and I are talking about. Like, this is not a thing about just teaching and saying, oh my gosh, you're going to learn some good stuff, go away. This is about survival and evolution, right? This is Darwin. This is not survival of the fittest. This is survival of the most adaptable, right? The most adaptable is in a market like this today. We got to do stuff that we didn't do before. So I realized in Expert Dojo that rather than just having accelerators and bringing in early stage companies, I needed to layer on private equity. If I didn't do it, if I didn't force some quick exits, then it would take too long for our companies to make it, for our limited partners to be okay. We all got to answer to someone. So I adapted. The first company that we've leaned into very heavily on private equity was Matchbook. So I pitched as a founder on Scott's show, pure and simple, and came out. And when the original deck from Matchbook is like 20 slides, which is all product, and I burned it. Right. I brought out 5 slides, Scott, just saying, hey, if you're an investor, this is how you get your investor returns. That's it. Like nothing else. Can you talk a little bit about that? Like the good, the bad, the ugly, kind of what you see on it, and just that approach to investors rather than the standard, here's my product that you don't care about.
Exactly. And the reason why I began hosting these events, and you've been, like you said, an investor for many of them, a host at some of the events we put on. And I tell people they get 5 minutes, and and what that does, they got to really boil down the key things that investors want to hear. What's your problem? What's your solution? And why is it better than anybody else's? How do you make money? And what are you doing to make money? Who's on your team and why are they best to execute? And then the ask. And you'll find we've done hundreds of these pitches, raised well over $100 million from these events from a 5-minute conversation. And I think it boils down to, as an entrepreneur, you don't know how much time you're going to get. You might get a minute, You make it 5 minutes, you make it 20 minutes, you better be ready. And what I mean by ready is don't have a pitch memorized, have it committed, be able to talk about it at any point in time, be on a LinkedIn Live and tell investors exactly what they want to hear. And a lot of what we do is get them ready for that. And obviously, you took 20 slides and turned it into the real core things that investors were interested in. Because at the end of the day, putting the money in is the easy part for investors. Getting money out, as we've already talked about, is the more difficult part. And if you talk about how they can make a return on their investment and a return of their investment, then you get the conversation moving forward.
Yeah, and it's worth mentioning, like no investor cares about anybody's product. Like they don't care whether you're a med tech company or a cybersecurity company or your data solutions, brain waving the greatest new innovation in blah 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 blah. They don't care. Nobody cares. Nobody cares. Like afterwards, they feel really good about being like an investor in Figma, which revolutionized and changed the way design. But like they don't care at the beginning. An investor, like there's a really good clue in the title, actually, right? Investor. They
Right.
just want to get more money back. And the idea behind, and I think this is something to me that like I've just taken on board so much. And again, I really want to get your view in it with your companies as well, Scott. But at the beginning, I used to think this technology is going to have a huge breakthrough. The market size is really big. There's a good TAM. There's a good sound. But then I was like, investors, they're just more basic than that. They're like, look, man, I can put my money in gold. I can put my money in stocks. I can put my money in like the bank. I can put my money in crypto. I can put my money in all these places across the board. This one gives me a 5% return. This gives me 7. This gives me 9. Now, I can put my money in a late stage venture capital. I can put it into SpaceX. And based on previous returns, chances is SpaceX will give me like a 2 to 3x over like a
Mm-hmm.
4-year period of time, which means I'm going to get probably bar bad luck, and as long as as long as Elon doesn't get like kicked out of the country, then like I'm going to get 25% IRR, internal rate of return. Put it in my bank, I'm going to get 5% IRR, internal rate of return. What is the projected internal rate of return of your startup company?
Right.
And many startups might think, well, I can't do that. But you can actually, because you can speak to at least your next round and you can
Mm-hmm.
speak to the logic of your next round. Like even when I pitched to all of your investors, Scott, I just said, look, our annual revenue right now is like 3.5 million. It's going
Right.
to hit 5 million by the end of the year because there's renewals and there's additions on top of them, which will take it to 5 million. The valuation is at 20 million, which means it's only a 4 times multiples on revenue. Now, I
Right.
know investors will like that because they know anything under 8 times is actually pretty damn good in the early stage startup space. They know it's a discount. But then I say, but there's better news because actually we can show you the activities leading to the meetings, leading to the sales that will take us to 10 million in annual revenue next year. And we all know that at 10 million, we're going to get an 8 times. So I
Right.
can take a 20 million valuation and turn it into an 80 million valuation with a 10% dilution, with probably 20% dilution, adding for the next one as well, within a 12-month period. Like that's what I'm offering you.
Right.
That's what I'm offering. And a 200% return or 300% return in that period is a great return. I mean, and that's how we have to speak to investors, right?
Absolutely. Because you find, and we both found the entrepreneurs, they fall in love with their idea, they fall in love with their technology. They have to realize that investors fall in love with returns. And you have to talk to them from that standpoint. How much money can you make if you invest today? And that's really the key to this. And you're absolutely right. Investors, we've had investors, you see it all the time. You see it in the public markets. There are, these SPAC blank check companies that are raising capital, waiting for a company to come in because these investors know, okay, I can get a return and I have some risk adjusted returns. But absolutely, you have to show investors how you make money and how you're going to return money. That's what they really care about.
Yeah. If you're going to give top tips, like biggest things that you've seen, Scott, over the years for founders to be able to take away to build in, I think number one, what we've just talked about is huge. Speak to the money, speak to the return, and speak to the probability of certainty to that return and what you're going to do to get there, as opposed to saying really dumb shit stuff like, if you can just get 1% of the market, it'll like, okay. So that's our baseline. What other things are you telling your founders to be able to incentivize investors to make that plunge?
Well, what I tell them is, one, build something today. Years ago when I was teaching at the university level, there was a study about McDonald's and Burger King. McDonald's used to spend $500,000 to determine where to put a McDonald's. Burger King waited till a McDonald's came up and built one in a 2-mile radius. Don't go for perfection. I tell everybody, go to the Microsoft model. Come out with your first edition. Let the market tell you what you got to change. Don't step over, great to get to perfection. And I think that's number one.
Before you go past number one, I just want to unpack them a little bit because it's so good. I had someone, one of the VCs, say to me the other week, and he's like, "Look, the objective for a founder is to smash the shit out of their first product as quickly as possible through feedback from their customer. Like, that's the objective. It's not to love your first product. It's to like build something out and desperately look for the feedback that will allow you to build a better product." Right. And so that's super powerful in what you're saying, because so many people send me like things, "Come here, can you sign an NDA?" And, "Hey, Brian, it's like super stealth." And I'm like, dude, do you not understand? Like, nobody other than you cares about this. Nobody. And so what you're saying is really powerful about getting it out to the market, but also the second part of actually really engaging with your customer.
Absolutely. You got to engage your customer now. And I want to touch on the NDA thing, because the reality is investors don't want to take the time and expense to sign your NDA. And what I tell entrepreneurs, don't give an investor a reason to say no. An NDA is a non-starter. Not having a good deck, good financials is a non-starter. I tell people, you should be ready before you talk to any investor. Don't think you can just simply send an email and something's going to happen. I'll tell you, really interesting. Last week, I got this cold email and said, "Scott, I'm investing in this really cool company. I'm starting this really cool company. Do you want to invest? Hit me up if you do." That was the entire email. And I read back, "That's your pitch?" I mean, be better than that. Be better than that, because the reality is you're going to get, in most cases, one shot at these investors. Make sure your idea is fully baked. You've built at least something that you can show them. I mean, hell, at least put together a landing page. We have entrepreneurs that just, "Look, I've got a napkin idea." Okay, that doesn't happen. That may happen with Jeff Bezos. That may happen with Elon Musk. That is not going to happen with Joe Sixpack, first-time founder. So be ready.
Yeah, I like that. And now we've moved over to communication, which is a wonderful topic, because you have the two sides of the spectrum, right? You have one side of the spectrum where people will write like entire novels about their company, which is worse. It's way worse, because it takes an investor like so long to realize they're wasting their time that they'll never start, right? And then you have the other one, which is like one line, this is my company. What do you see as being a good way to get an investor's attention? Like, how long is a good cadence? And how would you break down those paragraphs? If it's like 2 or 3 paragraphs or 4 or 1, like, how would you break down the paragraphs or the sentences to hit what you believe is going to be an activator for the investor quicker?
Well, you have to understand, this is marketing and this is sales, like anything else. So you have to have a compelling, subject line in an email with an introduction. You have to clearly define how big your problem is and why you're the right person to solve it. Talk about some of the traction, some of the highlights, some of the things that you've done. Short bios on the team members, because the reality is, if you're a new founder, if you don't have the resume, you better buy or borrow a resume to add to your presentation. And then really talk to them. I tell people all the time, start with the end in mind. Because the reality is, if you don't know how you're going to exit this thing, and you don't know who your potential acquirers or partners are, they're not going to tell you. And if they tell you, it's already too late. So I think, have a short pitch deck. And you had to have a couple of pitch decks. You have to have one for the person that says, send me this. You have to have the one for, a presentation online or in person. I think you really got to break it down. And it really comes down to doing investor research as to what to give them. When we work with entrepreneurs, we tell them who the investor they're talking to is beforehand, so they know who they're investing. And this is where it comes down to even list building. I find entrepreneurs, they may have a biotech company and they're slamming, a consumer product company investor with their pitch deck. Do the homework. Be honorable of their time and don't waste their time and your time. But when it comes down to a few pieces of information, it's sales, it's marketing. You're going to want to use the same relationship and the same development as you would with your potential customers and partners. But you got to give them compelling information, because you're going to have to move down that transom. You have to go from initial call to due diligence call to setting terms and getting a deal done. So, you're not going to have a lot of one call closes. So you need to be ready if they say, I want to know more.
Yeah. And it's a process, right? Like, you're going to see them at the beginning and you're going to do the email out. That email is probably not going to be replied to straight away. We know that the email outreach is low. Even if you hit them with LinkedIn, still pretty much the same. And then you're going to have a campaign that you're going to work with. The funny thing is starting from the end side, I had another great conversation the other day with an investor who had seen this research that had been done from people that had invested in founders. And the main reason that people invested was because they felt good about the founder. That's super interesting, right? Mm-hmm. It wasn't because they thought they were going to get rich, even though they probably did. Even the stuff with Elon would be because they just feel good about the founder. They feel good. Logically, it makes no sense to invest in Elon's companies. It breaks every single rule of venture. You don't invest in a founder that has 27 other companies. You don't invest in a founder who is totally disengaged from the other companies. You don't invest in a founder that's got a brand new idea that hasn't even started yet on a continual basis. But there are people who break all of those rules for Elon because they feel really comfortable with them. And that's why the whole situation with himself and Trump for so long was so worrying for investors, because they saw that if Elon gets toppled, underneath it's very, very, very hard to maintain. And that goes across the board. But here's the rub. As a founder, you don't get that for free, right? You got to build the right to get that relationship. And so when you've gone through a little bit how that initial introduction should go to, you write something, you make sure that it speaks to the end in mind very quickly. You don't spend a lot of time on it, but you give them the pertinent information that will just tease them and make them really excited. Maybe it's just a couple of paragraphs at the beginning, but then there's probably going to be another 5 to 15 touches. How do you suggest they do those touches?
Well, typically what I do with them is that the reality is, once you make your initial contact with an investor, you'll obviously get 3 answers: yes, no, or not yet. And if they're no or not yet, you basically have to don't hit them with email begging them for money again. Give them a compelling reason. Tell them something new. Tell them that the train is continuing to move out of the station. So typically what we do is we tell entrepreneurs every month, every couple of months, don't wait and give them small little bites of information. Don't give them a whole dissertation on what's happened in the last month. Give them, say, okay, we got this client. We had this traction item. We had this traction item. And then let them know. Because what I have found is you never know what thing is going to entice an investor. And you rarely know the timing of the investor. You need to understand something, especially in the world of VC. If you're a VC fund and you're raising money for your fund, you're typically not taking phone calls from entrepreneurs. You're out there talking to investors for your fund. And so you don't always know when that timing is. So have a cadence where you're giving them some 3 to 5 bullet points of traction that are demonstrating that you're not going anywhere and you're moving forward. And that's typically how we do with the companies we work with.
Wonderful. I think it's great. And then just I want to make sure people take away a few ideas that are really powerful on this call rather than lots and lots of ideas that they take away. So you treat your investor like gold. You make sure that you're reaching out to them with intent. You're making sure that you're actually going specifically after investors you think would be good for you. Bargav has just come here about a one pager, like the one pager versus pitch deck to initiate the conversation. Absolutely. Like we'll do that all the time. Scott, that's what I did on your pitch, right?
100%. 100%. You know, again, you have to understand they're getting hundreds of emails a month. Hit them with a succinct one pager that gets them to the next conversation. Keep in mind, you know, Brian, when you pitch at our event, I tell everybody the purpose of being on the event is not to get them to buy something right now, but is to get this investor on a second call. And we have a second call set up with you because you kept it very short, very tight, and very compelling, but for the investor to want to know more. And that's really, I think it all starts with one page.
Yeah.
I don't like to send pitch decks around because honestly, especially with VCs, it's probably going to be some college intern or some associate, you know, just out of college that's reading it. So you don't waste the PowerPoint. Put a one pager that compels them to want to get on the phone with you to learn more.
Yeah, I love that. So we have the email that goes out, or the LinkedIn, or whatever way you approach them. Very specific, to the point, end in mind. You have a plan for 5 to 15 follow-ups every single time. You are using very simple, easy to read with lots of images in there on a one pager, or I did it on a few pagers, but it was super clean and easy. You're not hitting them with big, long decks about a company and a product that they don't understand and have no ability to do. So that is think of a pitch deck that, as you would have used it before, as your product explanation. When you get to a time where the investor says, look, I would love 2 hours of the most boring time in my entire life to go through exactly what your product does. That's what your old pitch deck did. But in the meantime, you're hitting them with prompts as to why they're going to be successfully financially to be able to come with you. I got another question in here as well, which is coming from Divya, which is, do we need to highlight our social media achievements along with the decks to the investors?
Well, let's talk about what traction is and what traction isn't, okay? Traction isn't, 50,000 Instagram followers, okay? Investors don't give a rat's ass about that. What they want to know is, can you convert? How many actual customers do you have? How many people you have in your pipeline? In my own line of work, I mean, I'm very proactive about taking anybody I meet on social media and moving them through the communication funnel. Get them from a follower to get their email address, to get on a call with them or put something in front of them. You've got to be able to demonstrate you can work through the funnel. Investors don't care how many Instagram followers you are, of course, unless you are, the Kardashians, okay? Then it might mean something. But that's not a traction item, okay? Respectfully, I can buy myself 50,000 Instagram followers. I can click a button and buy that tomorrow. What the investors want, they go, who is in our pipeline? Who are our clients? Who's going to buy our product? So traction is not social media achievements. It's good to stay in front of them. Now, I tell everybody, if you do have a communication with an investor, follow them on all platforms, but don't harass them on all platforms. Let them see you. When I get a new investor that we working with, I'll follow them on LinkedIn and X and Instagram and all those places because I want them to see. Because in all frankness, we've had occasions where investors say, oh, okay, he did this. Let me reach out to them again. Very rare. But don't lean on social media. Find some real traction.
Yeah. And it's really funny because it's actually a very crypto question. And I never understood this in crypto, but it's like VCs will invest based on you having lots of followers. And that's only because I'm trying to think of how to say this in a nice way, and it's impossible. So I'm not going to say it at all. Okay. Just focus on the customer. And I'll make one point just to expand out the point, and then I want to take one more question, and then I want Scott to finish us off strong with like his views on just the most important points maybe we haven't covered up, we haven't covered on before. Actually, you know what? Let me do the question first because I think it's a good question, and then I'll bring this in with my final point, and then I want to follow with Scott. So, how frequently do we need to follow up upon what subject if we're reaching out to initiate the conversation?
Well, the first thing I would do first with an investor, ask for permission to send them a follow-up. Okay, don't just because you capture their email address in some form doesn't give you a license to spam them ridiculously. I think there's a certain cadence. We typically, if they're small, you could do small bites every 3 to 4 weeks. I think is good. If there's a major announcement, obviously there's an exception to that. But again, I would, if you get a no or a not yet, or you're not ready, say, thank you so much. And honestly, the thing you need to ask next, this is the simplest thing in sales. It's a simple concept. I trained, 5,000 salespeople. And if someone says yes or no as an investor, your next question is, who do you know that might be interested? Ask for a referral. You just don't know. They might say, you know what? How about you contact this guy? Then but how frequently? The cadence should be, probably every 3 to 4 weeks, maybe every quarter. I wouldn't do it weekly. That's way too much. I think a quarter you might just get forgotten about, have to start over again. But again, I would say 3 to 6 weeks is ideal.
Yeah. Perfect. Okay. And so first of all, just for all you out there, like Scott said something very important about earlier on, which is yes, no, or not yet, right? The only reason an investor is ever no for you is if they're ass broke, or if they do not invest in early stage startups, right? Otherwise, they are always a not yet, right? And that means that the only thing, even if think of it like this. If I went to you today, every single person here, and I'm like, everybody looking to buy a car. And I said, hey man, you want to buy a Ferrari? Our woman want to buy a Ferrari. And you're like, nah, I don't want to buy a Ferrari because I don't have 250K. And I'm like, cool. What if I gave it to you for 100K? And you'd be like, nah, I don't even really like Ferraris. I'm like, what about 50K? Well, I don't really have 50K. What about 25K? Well, shoot, 25K. Can I resell that for, okay, 10K, but you have to come down to my house and take it within the next half an hour, and you live 25 minutes away. Every single person here is coming down to pick up that car, right? Because it's the greatest deal on the entire planet. The same applies for, I'll give you SpaceX for the same price 4 years ago, and we're going to go back to that time. And stuff can still go wrong, but you know what you know. Every single person is going to buy. So everybody in the not yet just means they don't believe in you yet. But they know the system. The system is a formula. And the formula is, if you're growing your customers at 100 to 200% growth every single year, you are going to hit $5 to $10 million in revenue within a 5 to an 8 year period. End of fucking discussion. So the only thing you have to show is that you're growing at that rate. At the beginning, the investors may not believe you, but if you keep dropping the clues, like Scott said, a time will come when the investors like, okay, he's growing, she's growing at 100 to 200% growth every single year. They're going to hit the $5 to $10 million a month in revenue. It's going to be a unicorn. I'm going to make, maybe it wasn't a 200x before, but maybe it's going to be a 20x right now. I will invest. The problem with most founders is 97% do not follow up. Okay, Scott, last words for you, my friend.
Yeah, real quick on that subject. That's even sales. They say it takes an average of 6 closes to get to a yes. The average salesperson doesn't get past 3. So again, you got to stay in front of them. Final thoughts is this: is if you want to raise money for your startup, start 6 months ago, and in this 6 month time frame, do a couple of things. Build something that's investable. You can build something that's investable. You can build a pipeline of people that are on your wait list. You can build, a prototype. You can get people to sell version 1 of your product, number 1. Number 2, build relationships with these investors. Don't connect with them on LinkedIn and immediately, pitch them. learn about their portfolio companies and really do your homework. Make sure they're the right investor in the right industry at the right stage. Do homework on them. Understand who their portfolio companies are. We've had several of our companies start to work with a portfolio company of an investor, and then all of a sudden that portfolio company introduce them to the investor because you're in their same space, in their same stage, in their same vertical. So I think the reality is you got to keep building. And we're in a new era now in terms of entrepreneurs growing companies. This whole concept of this seed scaling is really the way to go now. Don't think and don't believe the hype. Just because on LinkedIn or on CNBC you're finding news about these startups raising money, understand something. We're dealing with a little leaguer going all the way to win the World Series. Those are the odds you're dealing with. So you might as well build something that can make money while you're trying to find some investors. And I do think we lost Brian. So with that, if he doesn't come back, I'm just going to say, again, my name is Scott Kelly. I am the founder and CEO of Black Dog Venture Partners. And there he is again. We got him back. I was going to close out the show for you, Brian, but you
don't need me. Come on. Can you put Scott's details up there? I want to make sure everybody can connect with Scott. Scott is the best there is when it comes to working with founders, investor, advisor, investment banker, anybody who's looking to pitch and get in front of a ton of investors and be really successful. He's the only one to go to. You have his details there, scott@blackdogvp.com. Thank you, my friend. Thank you, everybody, for joining us. I appreciate you all. Hopefully, you've learned a ton of tips.